Yo, what's good everybody? Welcome back to another video in the Day Trading Institution. So in today's video, what we're going to be covering is Confluence. So what I mean by Confluence is the term confluence and definition of confluence is basically when two things merge together. But what I talk about confluences in terms of trading is we're pretty much putting things together that make up a story that tell us that price has a higher probability of going in a certain direction versus the other, right? So when we have more bearish confluences, we have a higher probability of price to go bearish. When we have more bullish confluences, we have a higher probability of price to go bullish. And what we're going to do is we're going to determine a trade based off of our confluences. And what I mean by determining trade is I mean determining the probability of a trade, right? So first of all, what I want to cover before we get into anything is determining whether a trade is a low, a medium, or a high probability trade, right? So typically when we look for confluences, we look for them in one time frame. Now we can look for them on multiple time frames, but typically we want to look for them on at least 1 or 2 time frames, right? So when we have confluences, right? When we have 1 to 2 confluences, it means it's a low probability trade. So when you only have 1 or 2 confluences, typically you want to stay away from those types of trades. They're low probabilities. They don't look like they're really going to play out in your favor, and you want to stay away from those trades. Now, when we have 3 to 4, confluences, I don't know why I wrote confluences, we have a medium probability trade. And when we have a 5 plus confluences, we have a high probability trade, right? So when we have 1 to 2 confluences, typically the trade is going to be a very low probability trade, meaning that we should stay away from the trade until we have more confluences. When we have 3 to 4 confluences, typically we're going to have a nice medium probability setup. And really it's when we have 4 to 5. I want to put 4 to 5 plus confluences here. We have a high probability setup, meaning that we have a higher chance of winning because we have way more confluences in our favor, right? So now what are confluences exactly? Like I said before, confluences are more signals, right? So confluences could be the trend. Confluences could be an engulfing candlestick and the type of engulfing candlestick, right? So we could put here candle patterns. What else? We have moving averages, RSI. We also have, let's not even mention the RSI. We have the trend, we have candlestick patterns, we have supply and demand. We have fibs. We have fibs. We have rejections, right? These are all different types of confluences. Later on, what we could do potentially as well is rate our trade from an A or a B trade, because we always want to avoid the C trade. We only want to be taking A trades or B trades, right? So we're going to consider this an A trade. And we're going to consider this a B trade. What we're doing by marking off this as an A trade or a B trade is very simple. We're simply letting ourselves know that, hey, we had 4 or 5 plus confluences on this trade in our journal, so the journaling process is a little bit easier for us, right? So remember, a high probability trade, 4 to 5 plus confluences means that it is an A trade. A 3 to 4 probability confluence means it is a B trade, right? So again, we have the trend, we have candlestick patterns, we have moving averages, we have supply and demand, we have fibs, we have rejections of price, right? Everybody is going to have different forms of confluences. right? Like I said, it just depends on who you are as a trader, which will determine if that confluence is important to you or not. I did not want to turn on this indicator. I wanted to turn on my moving averages, which will determine if that position is important to you or not. What else could we have added as confluence? We can add break of structure. We can add a retest. It doesn't matter. Or we can even do market structure, which is also a zone, right? So right here alone, I have 1, 2, 3, 4, 5, 6, 7, 8 confluences that I literally just marked off for you guys. So you guys could use this as a base to build your own confluences, right? And again, all we're doing is tying in confluences together. So let's look at an example here. So let's say we're looking at price action right here, right? We see price going up, we see price going down, we see price going up, and we see price trading in this zone, right? So let's mark this off here. So let's say you're taking a trade and you're looking at the confluences. Let's say this is a 4-hour time frame, right? So we're writing our confluences down in our journal. 1, we have a previous level of market structure. 2, we have a bullish trend. 3, what else do we have? Let's say the moving averages are blue over red. So we have the SMAs. 4, right here alone, this is already a medium probability setup, meaning that you have a higher probability of winning than losing. 4, what could we add, right? Let's add a bullish engulfing. So referring back to our patterns here, right? We have a market structure. Price is currently trading at market structure, previous level of structure. I completely forgot. We have supply and demand. Let's just say, right? I can't believe I botched engulfing. We already have 5 confluences here. And we know that if we have 5 confluences plus on one time frame, we already know that this is an A plus setup, right? So we know that this first setup here is going to be an A, and you have a higher probability of winning, right? But now let's say price looks something like this, right? We no longer are trading at a level of supply and demand, and we're no longer trading at a level of market structure. You now have 3 confluences, which 3 confluences is a medium probability setup. Now, let's just say the moving averages aren't even involved, right? Let's write off our confluences here. 1, you have a bullish market structure, bullish trend, that's 1 confluence. Let's pull out the Fibonacci retracement tool. Let's see if we're at a retracement level, right? Let's just say it was right here, just for example. Again, this is just example purposes, right? 2, you have a 61.8 on fibs, which is another confluence. 3, what else could you add? Let's say price gave us an engulfing. Engulfing signal, right? Right here alone, you have a B setup, right? Meaning that it is a medium probability setup, which you still have a medium probability of winning. It's a little bit more than a low probability. It's pretty decent, but it's not a high probability setup. So what should you do on a medium probability setup? Ask yourselves this. What's the difference between a high probability setup and a medium probability setup? Simple. You have a higher probability of winning. Let's just say instead of you having a, 51%, you now have a 61% of winning, right? On a higher probability setup. So when you have higher probability setups, this is a time where you could definitely enter a little bit more in terms of risk. You could probably be a little bit riskier on high probability setups, and on a medium probability setup, you may want to tune down the risk a little bit. But what I want you guys to pretty much identify here are just the different types of setups here, right? So now let's say, and obviously in the next video, I'm going to be breaking down setups for you guys, right? Don't even worry about it. Let's say you have a setup like this, right? We're at a level of supply, or we're at a level of demand, my apologies, right? And you have something like this, right? So let's write off our probabilities. 1, we have a supply, we have a level of demand. 2, we have a double bottom pattern. 3, we have a bullish engulfing. So right here, we already have 3 confluences, meaning it is a medium probability setup, right? Now, can we add anything else? Maybe not just yet, right? But right here is a medium probability setup, meaning that it is a B setup. This is a B setup. Now, let's say price does something like this. You close your double bottom, great. Let's say price does something like this now. Okay, setup 1, done. And let's go on to setup 2. This is setup 2, right? So we have a previous level of, again, we're at a previous level of supply, right? 2, we have a bearish engulfing. 3, we have the SMAs being red over blue. And then we can also add 4, let's do fibs, right? Because this is probably like a 38.20, I want to say. Yeah, 38.20, right? So here, now you have 4 confluences together, meaning that this is an A setup, right? This is a grade A setup. Maybe you want to risk a little bit more on this specific setup, okay? And then you can, set up the trade however you'd like to set up the trade, or whatever the case might actually be is. Really, it all depends on you, right? So let's kind of continue this market structure here, right? So let's say price does this. And we're right here, right? Let's grade this trade. Let's see what type of trade this is. Should we take this trade? 1, we have a break of structure. 2, we have a level of demand. 3, we have an engulfing candlestick pattern. Wow, I'm really bad at typing today. We have an engulfing candlestick pattern. 4, we have the SMAs. And 5, we have fibs, right? So right here alone, we have 5 confluences. So you already know if it's 4 plus, that is a high probability setup. Why is this a high probability setup? Well, 1, price broke the downtrend structure, right? We went from low to lower low, or to lower high, to low to lower high, or in this situation a high. We went from low to lower high to low to high to lower low to lower high to lower low to higher high, and then now we are currently anticipating a higher low. So we have a break of structure, we have a break of trend. 2, we have a level of demand, which we know this is a level of supply and this is a level of demand. 3, we have a bullish engulfing candlestick, which is our entry signal. 4, we have the blue over red simple moving average, which we know indicates that there's more bullish volume within the market. And 5, we have a 38.20 pullback on the Fibonacci retracement tool. So we know that this is a high probability setup. This is a grade A setup, right? So hopefully you guys understand the concept of confluences. But again, what I want you guys to understand from this is just because you have a grade A setup or a grade B setup does not mean you will win. This does not mean you're going to win every single trade. All it simply means is that we've graded a specific trade to our liking, to where we could actually take the trade. If we don't have a minimum of 3 confluences, we are not taking that trade. And when you do have 3 confluences, you know that you don't have a lot of confluences, right? You have enough confluences to take a trade, but at the same time, you want to be very selective with your trades. As you progress as a day trader and you become a more professional, a more evolved, a more skillful day trader, you're going to start throwing away the medium setups. And you're only going to focus on those really high probability setups. Meaning that you're very picky with your trades. You're not entering a trade unless you see 4 or 5 confluences at minimum, right? But you could also take a trade at 3 to 4 confluences, right? Just know that when you take a trade at 3 confluences, you're going to risk maybe 1%. When you take a trade at 4 confluences, you're going to risk a trade at maybe 1% to 1.5%. It really depends on the setup. Trading is very situational. Not every setup is going to be exactly the same. But when you start getting into 5 confluences, 6 confluences, you know that, hey, this is a really high probability trade. I have a really high probability of winning, right? I'm probably going to go a little bit riskier. But just because you're going a little bit riskier doesn't mean that that one trade is going to wipe out 4 or 5 of your last winning trades, right? Just know that you still have that probability of losing. Just because you're trading at a high probability setup, it does not mean you will win. And I can't stress this out enough, because when people have a high probability setup, they typically get a little bit excited, right? They're like, yeah, I'm gonna make money on this trade. The words that you want to remove from your vocabulary are gonna and the market will, because the market will do whatever it wants. There's no such thing as the market can't get any lower. There's no such thing as the market can't get any higher, right? You really want to move those words from your vocabulary. Just because you have a 60, 70% chance of winning, there's still that 20, 30, 40% chance of you losing. And there's going to be times where that 40% wins against your 60%. It's very similar to the same thing at the casino on the roulette table. There's still that little percentage chance of you losing, right? And guess what? Just because you lose one trade doesn't mean you're going to win the next. You could lose 4, 5, 6 trades in a row, but win the next 2 trades and make back all those losses plus more. That's what you guys don't understand. Well, what a lot of newer traders don't understand, right? Trading isn't something where you're going to be winning every single trade in a row. You're going to have times of winning streaks where, yeah, you only take maybe 1 loss out of 7 losses, or out of 7 trades that you took, out of 7 winning trades that you took, right? But just like if you were to go to the roulette table at the casino, right? The house has an edge over you because they added that green color, going back to the beginning section of the course, right? There's times at the roulette table where you could literally bet on black every single time, right? And you lose 4 times in a row. It's gonna happen because there's periods of losses in the market. It's just gonna happen. You have to be able to really manage your risk, and that's how you're gonna stay in the game for a long period of time and make money, more importantly. So hopefully you guys did enjoy, understand this little video. I know I kind of went on a little rant there, but throughout the entire section throughout the entire day trading institution, I want you guys, I'm really trying to be as transparent with you guys here as possible. And I'm telling you guys, trading is made up of 80% psychology and the rest is simply money management and technical analysis. You can have all the confluences in the world, but you still need to be able to control yourself emotionally. Just think about this. This is a live trade that I took, right? I took a position somewhere along this area here with a stop loss up here, and my take profit, one is 2.5 right here. My second take profit is here. My third take profit's here, right? Keep in mind, at one point on this trade, I was up $10,000, $13,000, something like that, around there. Right? I think it was around here. I was up like 10 grand. Then I was up like almost $20,000 at some point. Then price went against me, but I still had the will and the emotional control to hold my position, because I know my main target is down here where I'm going to make 30-some thousand dollars, right? And look at price go completely against my position. But I had the discipline to hold to my initial target, which is down here, right? Because I know that if I win this trade, I'm going to make at least 3 times my risk, and I just paid for another 3 trades, right? That's exactly how you want to think about trading. I just won this trade. This trade just paid for my next 6 trades, because I'm only going to be risking $1,000 for the next 6 trades, which should, even if I lose 6 trades in a row, I'm going to break even from today's profits, right? Not as simple as that, but that's the concept that you want to look at, right? Anyways, guys, I went on a little bit of a rant there. In the next video, we are going to be going over Confluence trading and just break down the charts for you guys so you guys can understand how to perform technical analysis.